After the budgets have been prepared, you're going to, as a company, want to do what's called pro forma financial statements. They're predictions of what your financial situation will be, and it's based on all those budgets. So we're going to again use pasta disasta, and we're going to basically go through each one of these and record them so that we can then prepare the financial statements. And we're not going to use debits and credits, though I'll mention them. We'll use just pluses and minuses just to keep it simple. So let's go through. We have first, you're investing 80,000. So you're going to, as a business, get cash, debit cash, and give stock to the owner, you, and that's common stock. Now, as far as you're going to take that 80,000 or 48,000 of that 80,000 and buy that furniture and equipment. So you're going to pay out the cash, credit cash, and debit equipment. Now, for sales here, if you recall, we had 24,000 in sales for the month of June, but we're not collecting all of it. So the way you'd record that is you'd credit your sales for the full 24,000, but what you're getting is only 19,200 in cash, and the rest is accounts receivable. That's the 48 that we did earlier. As far as the food costs go, we, if you recall, we were going to purchase 7,200 each month, but we're not paying for it all. So we only pay the 90% of it. The other 10% is accounts payable. So again, you buy 7,200 of goods, and of which we're going to pay 6,480, and then we are going to owe 720. Now I have this as cost of goods sold instead of inventory because we're not needing to go through that step, because we're not going to have any inventory at the end of the day. We expect to sell it all at the end of the day. As far as the other expenses, you've got your 3,000 to pay for your employees. You have, and actually that should say salary expense, you have 5,000 for your rent, right, rent expense. You've got 1,000 for utilities. You got 3,000 for insurance, 200 for your advertising, and if you recall from earlier, we aren't going to record depreciation as a decrease to cash. Instead, what we have to do is figure out how much the expense is. So we're not going to expense all 48,000. The matching principle says you're going to spread that cost over the periods that you benefit, and we're supposed to use this or benefit from this equipment for 10 years. Now that would give us an annual rate. I just want to record 1 month's worth, so we'll take 1/12 of that to get that $400 per month. And then to record it, you're going to reduce your assets. You don't reduce the equipment account directly. You reduce the assets by using the contra asset account called accumulated depreciation, and then the debit is to depreciation expense. Now what you do is prepare your financial statements, and I've got it nicely color coded, basically red being your income statement, and then you would do your cash flows, which is all of these entries that affected cash, and then you do a balance sheet, which is tallying up all the assets that you have, liabilities, and then stock, and then retained earnings. Now I'm going to just jump ahead and show you what the end result is, and I'm going to point out a couple things. We're going to take, because this is for managerial purposes and not financial reporting, we're going to take this income statement and present it by splitting up our costs between variable and fixed, like we've done in a previous module. So what we have here is our revenues of 24,000, and the only cost that was variable, meaning it changes in total when your number of customers increases, let's say, or decreases, is the food costs. All the other costs are fixed. Whether you have 1 customer, 2,000 customers, or 5,000 customers, these are the costs that you'll incur for the month. Now, if you recall, we set this up where you take your revenues minus your variable costs to get your contribution margin, and then you subtract your fixed costs to get your operating income. So we'll be using that here in another video. Now, as far as the cash flows, you have to remember you have some that relate to operating activities, And those are all your purchases, well, your cash collections from your customers, and then all the purchases. What's not here is the purchase of equipment, because that's an investing activity. And then under financing activity is the issuance of stock. When you tally all that, your cash changed by 32,500, and in June you had no beginning cash, so your ending cash will be the same as it is on the balance sheet. The accounts receivable was the 4,800. Our equipment net of accumulated depreciation is the 48,000 minus our expense of 400. So our total assets are 84,920. And then accounts payable, that's that 10% of our purchases we didn't pay. And then our stock and retained earnings in this case is the same as net income, because there's no mention of having dividends. So our total, as always, balances. In other words, our total assets equal our total liabilities plus shareholders' equity.